Now, every investor would love to invest into the markets and get an income source. And yes, to be a investor or a trader for a very, very longer time, you need to understand what are the different forms of investment and what are the various sources of investment. Now, majority of the people are investing. So now today we will be comparing between equity market and derivatives related, right? What is the comparison? What is the difference? And I want you to understand the basic part and the basics of derivatives market, right? Derivatives market. So let me share my screen and we'll discuss about some golden nuggets, right? Some golden nuggets. First of all, in cash market, what do you mean by cash market or equity or stock market? Whenever you purchase a stock, right? The normal stocks buying and the stock selling will happen in the cash market, right? Will happen in the cash market. And here, this is a one directional market. What do you mean by unidirection? Unidirection means if a stock is improving, you purchase it, and if the stock is declining or the stock is falling down, you simply sell it. So it's a one direction. It's not a bi-directional market, it's a unidirectional market. Whereas in F&O, right? F&O is a bi-directional market, right? F&O is a bi-directional market. And yes, in futures and options, the probability of making profit is higher with a lesser capital along with a higher risk. I repeat, in future and options, people try to make huge profits with less capital along with higher risk, right? Yeah, let me add here along with higher risk. So if you have been successfully able to do it in cash market and you wanted to explore the other sources in F&O, let me give you a small example, right? Let me give you a small example. Let us suppose any large cap stock which is already there in F&O list, right? Which is already there in F&O list. Be it like ICICI Bank, HDFC Bank, Adani Enterprises, any stock you take. Right? For now, let me take the example of Adani, right? Adani Enterprises. I don't know how many of you are aware. Adani Enterprises, the promoter stake has increased, right? By around 2.3%, right? By around 2.3%. Now, you expect some positivity in the stock. You expect the stock to move little higher, right? Little higher. So one, you can purchase like 1,000 stocks of Adani Enterprises if you have higher capital, right? Scenario one, sir, I have good capital. So you purchase in the direct stock market, which is a unidirectional market, 1,000 worth of shares, 1,000 into the market price, you have to bring in that capital, right? You have to bring in that capital. Two, sir, I'm sure the stock will appreciate and I have a positive view on the stock, but I don't have the capital to purchase 1,000 stocks into the market price X amount of corpus. You don't have that. What you can do, either in futures or in options, right? Even in options, in lots, you can purchase it in lots, right? What you will do? You will purchase it in lots. Whoever have been applying an IPO, right? Initial public offer. So how you have lots there, here also you'll be having in lots. So every lot has X number of shares, right? This is predefined by the exchange and you need to purchase in lots. So here, instead of you spending the entire amount of total capital, you have something called as margin money, right? This margin money will be decided by the exchange. If you bring in that money, that is sufficient, right? So if you see the difference between the cash market and the derivatives, futures or options, both, right? Both related, with a lower capital, just the margin money, it is also called as margin or premium amount. You just need to bring in the margin or premium that is decided by the exchange. Yes, this amount is the minimum margin required. So with a lower capital, you're able to take a higher exposure. And yes, as the capital is low, if you're making a profit, the percentage of returns will be higher. I hope everyone are getting this. In the first scenario, you're bringing a very high capital, and let's say same 1,000 stocks of Adani, right? If you're investing 1 lakh in cash market to have that position, and if you are making 10,000 as the profit, your percentage of profit is how much? 10% here. In the second scenario, the same exposure what you have taken, if the margin money requirement is only 50,000, because you need not bring in the entire capital, and out of that 50,000 of your investment, if you are making 10,000 as profit, the percentage here is 20%, because lower capital, even though the same amount of total profit you made, percentage is higher, right? Percentage is higher. That is the advantage. And beyond that, the last point which you also need to remember is risk is more, right? Risk is more. So here, as you get exposure with a lower capital, if you do not know what you are doing, and if you're not giving sufficient time to learn and do it, chances are very, very high, right? Chances are very, very high. You get tempted to take more number of lots, and one exposure will completely kill the returns. And yes, that's why we need to learn on the hedging. And if we do it carefully, we can succeed. But yes, remember, derivatives, futures, options related, it's a bi-directional market. We'll discuss about it. You can make a good money, but you should be cautious, and after understanding, then only you should be doing it. And expectations are so high, and they take high margins also, which means, right? Which means if you are increasing your risk, right? Means we'll come to it as we go forward. If you are hedging your portfolio, which means you have a backup, then the margin requirement will be lower. If you are not hedging, if it is a naked position, then margin requirement will be high, right? So hedging means it's like an insurance. A person who is taking insurance policy is more safe than a person without insurance. Similarly, in F&O also, derivatives related, if someone is not hedging their portfolio, exchange will demand a higher margin. And if you are taking a hedged position, the margin will be lower because you are taking a little lower risk. And yes, why F&O is bi-directional? Sir, what exactly do you mean by bi-directional? I've just given an example of Adani or any company which is increasing or which is bullish. Let's say a stock which is already there in derivatives is bearish. You can take a position which is in bearish also. Yes, this company, as it falls down, it is falling more, you can make money also there, right? So yes, you can apply strategies either in the bullish or bearish market, and you have strategies to minimize the risk, right? You have strategies to minimize the risk. And also, just a small example, in 2008 or 2020, during the 2008 bubble or even 2020 COVID crash, I know there are many members who have burnt their portfolios in cash market, right? The entire stock market has started falling. So let's say in the scenario one, you are just investing into the stock market and the entire stock market is completely crashing. So you can't do anything, right? If the overall market is falling and in the overall market, many stocks are falling, you can't do anything except that you exit and preserve your capital or minimize your losses. Alternatively, if you hedge your portfolio, hedging means what is falling stock market, which means Nifty 50 is falling, which is our broader index, right? Nifty 50 is falling. So in derivatives, what you can do, you can short Nifty. What do you mean by shorting Nifty? Shorting Nifty means as Nifty is falling, the more it falls, the more you make money, right? You are not bullish on Nifty, you are bearish on Nifty, right? You are bearish on Nifty. So person A who has only the stock market portfolio, have not hedged his portfolio, when the overall market is falling, his entire portfolio will come down. Person B who have investments in the stock market, his portfolio is there, his portfolio is falling, but he has hedged his portfolio, right? He has hedged his portfolio. In that scenario, even though the stock market is falling, as he has shorted Nifty, he will make money there, right? He will make money there. He can take a put, or even if he is a seller, he can sell call option, right? Maybe we'll come about it later about how we can short, what are the options we need to prefer. But I want you to overall analyze on this. So hedging means if your stock market portfolio is falling, as the hedged portfolio will increase because you are taking a bearish position. Scenario B, this person will be at break even though market is falling, and even he makes money as the market is going down. He makes money in the derivatives part. And yes, as soon as the market bounces back, he closes his short position, he squares it off, and the portfolio will be increasing, right? Portfolio will be increasing. So that's the advantage of a bi-directional market. Yeah, that's the advantage of bi-directional market. And yes, shorting means you are selling first and you buy later. Buying later means you square it off later, right? So if you're selling first, means as the price drops, you make money, right? As the price drops, you make money. So what is happening? As F&O is bi-directional market, you can either invest in the upward journey or in the downward journey. You can apply certain strategies, minimize risk. Apart from that, you can earn income from portfolio, right? You can earn income from portfolio. And yes, hedging, you can sell Nifty future, or you can sell the Nifty options related. As the market is going down, you make money. Apart from that, Adani Enterprises, right? During January, Hindenburg report related, right? We are very sure that yes, the stock comes down for the next couple of days. During that time, you can just short Adani Enterprises. You are selling Adani first, and then later you buy it. So that is called as shorting. As long as it goes down, you make money there. We can either sell a call, or even we can buy a put. Yeah, you can buy a put. And there are people who will have some confusions or some doubts. Sir, if I'm selling and later if I don't find any buyer, so I'll be stuck in the position, right? Do not have that kind of a confusion, because this market is like a very high traded volume. And also, whatever stocks are there in the cash market, in your stock market, all are not there in derivatives, right? Exchange is very, very strict. They have a defined rules. X stock has so much of a volume, and yes, it is able to sustain its price. It's not too volatile. 20% fall on a single day, 20% fall on another day. No, it will not pick up those high volatile stocks. It will not pick up low volume stocks, right? Out of the entire thousands of stocks in stock market, there are around 193 to 194 stocks which are picked up by the exchange, and the cycle repeats every 3 months. Only those 194 stocks will be traded in the derivatives part, right? So most probably the volumes will be there, right? So if you are buying, some other party is selling. If you are selling, some other party is buying, right? So that kind of a thing is taken off, it's taken care. And yes, exchange, it reviews the system every 3 months like that, and if any stock is not satisfying that conditions which are preset, they will move out of derivatives, they will only be in cash market, they'll not be traded in derivatives, right? So that thing is taken care by the by the exchange. And yes, in cash market, as I told, whatever capital you have to infuse, you have to infuse the entire overall capital. Whereas in derivatives or in the futures or in options, you can use the margin money, right? Margin money, and it's also called as premium. Sir, how will I decide the margin money? Do not worry about it. It is already predefined by the exchange and your demat company, depending upon the risk. Let us say person A have not taken any hedged portfolio. That position has unlimited risk. We'll discuss what is unlimited risk. Margin money will be more because the risk is high. Person B has invested and he has hedged. He has taken a position, he has taken another position so that he does not have unlimited risk. In that second position, the capital requirement or the margin money will be little lower, right? We'll discuss about what is hedged, what is unhedged, right? Which position is left naked. Naked position means no hedging is available there, right? We would be discussing on that, right? We would be discussing on that. Okay.